Motivation Monday. If you keep doing the same thing that you've been doing, you're gonna keep getting the same results that you've been getting. Do you wanna change your life? Do you want a radical change in your life? I'm here to help you do that. Sell options, create income for yourself on an ongoing weekly basis. You see how I pay for this view? Trading options. I do it, you can do it too. 2 easy strategies that you need to know. Sell a put, sell a covered call. Listen, you don't need to day trade. You don't need to study these fancy charts or understand these like crazy concepts that are confusing to learn. No, 2 easy concepts. Sell a put. What does that mean? I pick the stock and I'm gonna commit to buy 100 shares, but only if it drops in price. If it doesn't drop, I don't buy the shares. Either way, I get paid to do that. Why are you guys trading stocks when you could trade options? I'm gonna show you exactly how easy it is. I'm gonna walk through 3 tickers in this video, and I'm gonna use my trading platform. I'm gonna show you exactly what to look at. No jargon, no fluff. I'm gonna calculate your rate of return right on the screen. These are ideas that you can just take and you can use right away if you wanted to. Do you wanna learn more? I'm having a live event 2 weeks from now. It's totally free. I'm gonna put the registration link below as well. I'm gonna show you exactly how to sell a put, how to sell a covered call. It's super easy, guys. If you think options are risky, you are misunderstanding it. Now do me a favor, before we jump into the video, that subscribe button on the bottom right, subscribe to my channel. I am literally putting up a video each and every single day for 1,000 days. I'm here to help you be successful. Now I'm gonna show you 3 great tickers that you can trade right away that have low dollar costs, so you don't need a big account to trade it. Okay, let's jump right in. Okay, first we're gonna start with Cipher Mining. It's a Bitcoin mining company. It's only $22.76 per share as of the close on Monday, and it has super high volatility. Someone asked me on my YouTube channel to walk through trades for Cipher, and I'm gonna start with this one. I'm gonna do 2 other tickers after this, so stay until the end of the video to see all 3 trade ideas. So first we're gonna start with right here. This is a 1-year chart. So this is my platform, Thinkorswim, and we can see this is where the stock has been trading for the past 1 year. You'll see today, Monday, it went up super high and then it kind of came down a bit and it closed, like I mentioned, at 22.76. So let's take a look at the options. We're gonna click the trade tab and the strike prices are down the middle. As you can see here, the puts are on the right-hand side and the calls are on the left-hand side. Now, especially when you're new, I always suggest that you start with selling a put. What does that mean? That means that you're committing to buy 100 shares, but only if the stock drops below the strike price before the expiration date. Now, we're always gonna look at 1-week expiration date. Why? 2 reasons. Number 1, I don't want to tie up my capital for an extended period of time. And number 2, I want to create weekly income for myself. Now you'll notice the implied volatility here on the right-hand side. And as I mentioned, Cipher has super high implied volatility. Now implied volatility gives you 2 advantages. Number 1, it gives you a higher premium when you're selling contracts. And number 2, because it has high volatility, it means that it goes up a lot and often, and it goes down a lot and often. That gives you the comfort of knowing that if you sell a put, if you were to get assigned the shares and have to buy those shares, if the stock goes down, it can be very likely for it to pop back up because the implied volatility is super high. So that's good when you're selling options. So let's take a look at a couple of different choices. Now, when we decide what strike price we want to use, what we want to do is we want to consider how interested we are or how okay we are to buy 100 shares. So in other words, if I was to choose a strike price that's kind of close to where it's trading now, $22.50, that's going to give us the most premium. If I wanted to be a little bit more conservative, I could go down in strike. Instead of using a 22.50 strike, I can use 22 or 21.50 or 21. You get the idea. Another thing that I want to point out to you guys is this delta column. Delta gives you an idea of the statistical likelihood that the stock is going to drop from where it is below the strike price before the contract expires. So the lower the delta, the less likely it is to drop to that value. And that makes sense, right? So let's walk through a couple of different choices. So for example, the guy who asked me to do a video on this stock, he likes this company. So if you like the company, you might consider selling a put that's a little bit closer closer to where it's trading now, such as $22.50. Now, before I sell a put, I'm always going to calculate the rate of return. Why? Because I want to make sure if the trade is good or not based on how much I'm getting paid versus how much I have to commit in capital to make the trade. So in this scenario, I'm going to commit $2,250 in capital. Why? Because it's a $22.50 put. So I'm going to divide the premium that I'm getting, and this contract last traded at $141. And remember, $141 gets dropped into your brokerage account right then and there. You don't have to wait until the stock does something in order to get paid. That's one of the advantages of selling options. So I'm going to divide $141 divided by the capital that I need. In this particular scenario, it's $2,250, and that gives us a rate of return of over 6%. But remember, guys, this is only for 1 week. If I was to annualize this out, I'm literally making 325% on my money. Why? Because this stock has uber high volatility, and the higher the implied volatility, the more you get paid on the contract. Now let's compare that to a more conservative trade. Let's say I wanted to look at a $20 strike. A $20 strike means that I'm committing to buy 100 shares, but only if Cipher drops below $20 before the contract expires on November 7th. This contract last traded at $45. So let's calculate that rate of return. $45 divided by $2,000, because we're committing to buy 100 shares at $20 if the price drops. That gives us a rate of return of a little bit more than 2%. Not too shabby. If we annualize that out, we're still making 117% on our money. Oh my gosh. Let's go even a little bit more conservative. Let's go to an $18 put. An $18 put says that we're committing to buy 100 shares, but only if it drops below $18 before it expires on November 7th. Well, as we can see here, it last traded at $18. So an $18 put last traded at $18. It has a 9 delta, meaning that it has approximately a 9% likelihood the stock is going to drop from where it is now, $22.76, below $18 before it expires on November 7th. So very, very unlikely. So we're going to divide $18 divided by 1,800, because that's the capital that we're putting up. We're still making 1% on our money. If we were to annualize that out, we are literally making 52% on our money. You know, sometimes people will comment on my YouTube channel. They'll say things like, there's no way you can't make 50% per year. There's no way you can't find trades that will pay you 1, 2, 3, or 4% on your money every week. I'm showing you exactly on my trading platform how you can absolutely do that. Now let's jump right into the next stock, shall we? CLSK, one of the largest US Bitcoin miners. And someone else from my YouTube channel asked me to do a video on this one. And so I'm going to do the same thing. I'm going to walk through a bunch of different trades and show you how easy it can be to evaluate trades. Can you guys see yourself doing this on a regular basis? It's not that hard. So first we're going to start with a 52-week chart, just like we did in the prior example. So we can see it kind of like went up, it went down, it kind of stayed a little sideways, up, down, up again. And CLSK is CleanSpark, also a very highly volatile stock, which is very good for premium, as well as if you do need to buy it, if the stock drops after you sell a put, you can have some comfort in knowing that it can likely go back up because it does have high volatility. So let's take a look and see what the options are trading at. And now the stock itself is trading at $17.42, so it's a very, very low cost stock as well. So if we were to look at, let's say, a $17 put, you'll see that last traded at $62. And you'll see the implied volatility 117%. Anytime the implied volatility is higher than 100%, that's considered to be very, very volatile. So let's take a look at sort of like a more conservative trade, maybe like a $16 put. A $16 put, that means that we're committing to buy 100 shares, but only if it drops below $16 before the contract expires on November 7th. And you'll see this contract last traded at $28 and it has a delta of 22, meaning that it's only 22% likely that it's going to drop that low in the next handful of days. Let's take a look and see what our rate of return is, shall we? Okay, so we're going to divide $28 that we make divided by the capital that we have to put up to make the trade, which in this case would be $1,600 because we're looking at a $16 put. That gives us a rate of return of about 1.75%. But again, guys, this is only for 1 week. So in order to annualize that out to see if it's a good trade or not, we're going to multiply it by 52 because there's 52 weeks in a year. And what this is saying is if we did a trade like this once a week for a year, we would be making 91% on our money. Super, super high. Next, let's take a look at CONL. CONL is an ETF that intends to double the return of Coinbase. So first we're going to look at the actual stock, the 12-month chart. And then also what we're going to do is we're going to put it side by side to Coinbase just to see the correlation between the two. Okay, so you'll see CONL on the left-hand side, and then we'll see Coinbase on the right-hand side. And you'll see that they look very, very similar, right? So CONL goes down, goes back up again, kind of gaps down here, and Coinbase has a similar pattern. So next we're going to look at the options contracts for CONL, and we'll see that CONL is trading at $34.05 per share. And oftentimes we can use these ETFs because they're significantly less expensive than the underlying it's pegged against. It does have more risk though because this is a 2 times ETF, meaning that it's intended to magnify the movement of the underlying, right? So if CONL is $34.05 per share, we're going to take a look at a $34 put. And I'm going to give you a few different comparisons. So again, with this particular stock, we see very, very high implied volatility. In fact, 122%. Again, anything over 100% is very, very high, meaning that you get paid more in premium, as well as the comfort of knowing that should you have to buy the stock, if the stock dips, there's a very high likelihood that it will pop back up and you could sell a covered call and make money again. So let's calculate our rate of return. On a $34 put, it last traded at $181. So $181 gets dropped into our brokerage account, and we're committing to buy 100 shares, but only if it drops below $34 before the contract expires on Friday. Now it's already trading very close to $34. So this is what we would call an at-the-money contract. You would make this trade if you really like this particular stock. So instead of buying 100 shares and paying retail price, you can sell an at-the-money put only by if it stays low or goes lower than the strike price, and you're getting paid to do that. In this case, $181. So we're going to divide $181 divided by 3,400, which is the total amount of capital that we need to have to make this trade, assuming not using margin. This is called a cash secured put, and that gives us a rate of return of a little bit over 5%. But again, this is only for 1 week. So in order to get our annualized rate of return, we multiply by 52, and it gives us a rate of return of 276%. Oh my gosh. I mean, and here's the thing. Monday, this particular ETF dropped 7.77%, meaning that when a stock drops, the price of puts goes up. So you're getting paid more for the risk that you're taking. Now let's kind of compare an at-the-money put to something that's a little bit more conservative and a bit out of the money. Let's take a look at a 3150 put. So you'll notice a couple things right off the bat. You'll see the bid price of 10 and the ask price of 90. That means there's a very, very wide spread between the bid and the ask. Typically, that's the case for contracts that's not traded as frequently as, let's say, a regular stock like Coinbase or something like that. When you do have a wide bid and ask spread, it is a little bit harder to get in and out. So you want to keep that in mind. So let's calculate the rate of return. This contract last traded at $70. So we're going to divide $70 into 3150. That's the capital required in order to make the trade. That gives us a rate of return of a little bit more than 2%. Oh, look at that, 0.02222. Any numbers, people out there? 22222 typically means balanced for any numbers, people out there. So again, this is for 1 week. So we're going to get our annualized rate of return by multiplying by 52, and that gives us a rate of return of 115%. Oh my gosh. So you guys can see how easy it can be to make significantly high rates of return. And the worst case scenario when you sell a put is if the ticker goes below the strike price, you're purchasing 100 shares at the strike price. Remember guys, you pick the stock, you pick the strike price, and you pick the expiration date. So you don't have to trade these aggressive sorts of Bitcoin type stocks, but I would encourage you to look at cryptocurrency, look at Bitcoin for part of your holdings. And the problem with buying straight Bitcoin is it's just like stock. You can buy Bitcoin and you have to wait for it to go up, then you have to sell it in order to recognize any income. When you trade options on Bitcoin type stocks, you can create yourself a steady stream of income on a weekly basis. Anyway, I hope these videos help. If you like this video, smash the like button, subscribe to my channel. I'm putting up a video each and every single day. I'm hosting a live event totally for free a couple of weeks from now. I'm going to drop the registration link in the comments below. Let me know as well in the comments, what do you think of Cipher? What do you think of CleanSpark? What do you think of CONL? What do you think of Coinbase? What are your favorite tickers? Are you pro-Bitcoin or anti-Bitcoin? Or do you like to trade different types of asset classes? Anyway, hope that's helpful. Thanks for watching, and cheers for now.